our perspective does. And it's a great opportunity for all of us to stop and reflect on our lives and what we've done in the last year and what we're going to do in the next year. And I hope all of you took a little bit of time to do that, maybe before or just after the new year. Really set out a plan or a roadmap for 2022. Um, on the topic of plans, just for a moment, um, I think a lot of people look at planning or making a plan as something that it probably is not. That is, a lot of people will say, "Oh, well, I don't like to make plans. They never work out anyways." Or, "I don't like to make plans. You can't predict the future." And people say things like that, and they think that it's a very, wise or intelligent observation that obviously plans don't work out and that the future is unpredictable. And both of these things are true. If you make some plans for this year, I guarantee you some of them will not work out. That is how life works. But I think that these individuals they miss the point, because the point of planning is not that your plans are perfect and that they're able to accurately predict the future. The point of a plan is that it's a roadmap, it's a guide. It says this is where I'm trying to go, and this is how I'm going to try and get there. And of course, in life, sometimes you have a map, and it tells you to cross a river, but the river is flooded. This is maybe not a problem we encounter in the modern world, but it certainly used to be a problem, right? Maybe the river is flooded is a bad analogy, but sometimes there's roadworks, right? There's construction or something, and you need to take a detour, right? So you can have a map that points you to where you want to go and tells you how to get there. But sometimes in life, there's roadworks, there's detours, there's construction, there's moose on the road, whatever it is, right? And so similarly, your plan, right, is not a perfect map that you can depend on, right? Like life, just like driving a car, you might have a GPS, but that doesn't mean you trust it blindly, right? And in the same way, making a plan is very much like having a GPS. It's going to try to get you to where you're going, but you still got to keep your eyes open for the changing conditions on the road, right? But having that map really allows you to make smarter decisions, right? Because you don't have to consider every option every time they're presented to you because you've already laid down a roadmap at the beginning of the year or whenever. I mean, it doesn't have to be at the beginning of the year, but whenever you made your plans, that allows you to very quickly and easily evaluate your options, right? To give you a simple example, this year, one of my goals is to acquire at least three more fourplexes, right? I actually don't care too much about the configuration. It's more about acquiring 12 doors, but I want them to be in multifamily, not like a single apartment building. Uh, and of course, in order to accomplish that goal, it means that I need to buy at least three fourplexes, or I need to buy two sixplexes, or whatever you're going to have to do. Which means that when someone comes to me with a deal and they say, "Hey, look, here's a fantastic deal on a duplex," and it might be a fantastic deal, I don't really have to spend a lot of energy thinking about the deal. I know right away I'm not interested because I need to buy fourplexes this year, right? And so plans are really great in that way, if as long as you can kind of abide by them and say no to people, right? Same thing if you decide this year you're going to compete in a bodybuilding competition, right? And your friends invite you out to a potluck dinner. Well, you probably don't go, or if you do, you bring your own food or whatever, right? Because you've decided that this year your diet and exercise and health plan is going to be paramount importance, and you can't afford to have social outings to potluck dinners where you're going to eat like macaroni casseroles and crap like that. So, anyways, I hope you all have spent a little bit of time thinking about what you want to do this year. I like to write goals down, in like a notebook, and put labels and stuff so you can look back year over year, and kind of see where you were at the years before and what you accomplished and didn't accomplish, and why, and try to learn to be better. Because we're all always growing, right? That's one of the things in life. It's like none of us are perfect. None of us are able to do all the things we would like to be able to do, but we all have the capacity to grow and expand ourselves to do the things that we aim to do. um Anyways, um I want to talk to you um about stagflation. um I'm going to talk to you about stagflation, what it is. It might be a term you've heard before. If you had taken a class in high school or university or college about economics, you were probably taught this term. If you didn't, then you've probably never heard of stagflation. And it does sound like a made up word, stagflation. It is, obviously related to inflation and deflation. So if you understand what those terms are, you might have an idea of what stagflation is, but I want to explain it to you. For those of you who don't know, right, I did go to school. I studied economics or business and economics, whatever. Um, and I remember learning about stagflation. Um, and I remember learning about stagflation, and I thought to myself, well, that sounds bad. But seeing as you're teaching me about it here in this classroom, and you know what causes it, and you're teaching me what causes it, doesn't seem like something we'll have to worry about. There's lots of economists in the world, so I don't think we'll ever have to worry about stagflation. Unfortunately, I'm older and I'm wiser now. That even when you can see a problem coming, it does not mean the society will turn away from it. So, stagflation is an important thing to understand. Uh, to explain it to you, I'll just start a brief overcap of inflation and deflation, right? So, inflation is either a growing of the money supply or a shrinking of the supply of goods and services, which results in prices increasing. Pretty simple, right? So, if we print money, then next week the gas prices go up, right? Next week the price of bread goes up, next week, whatever. We're experiencing inflation right now. You're all seeing it at the grocery store, the gas station, wherever. That's inflation. Deflation is the exact opposite of inflation. It's when the money supply is contracting or the supply of goods and services is expanding, right? And this is when buying power increases, so prices fall, right? So the value of your dollars goes up over time. You've never seen deflation in your lives, at least not in the Canadian dollar. However, if you were to look at something like Bitcoin, Bitcoin is a deflationary asset now. The debate is on, is it an asset? Is it not? Blah, blah, blah. What is it exactly? And time will tell. I'm inclined to believe that it is an asset that is somewhat akin to a currency. And if we do consider it to be that, then it is deflationary in nature because the supply of the currency is controlled, right? There's a limited supply of Bitcoins. They will not be increased, at least unless someone somehow breaks the code, right? And so, therefore, after the last Bitcoin is printed, about 100 years from now, there will be no more. And so the value of the coin will become deflationary. It already is, really, but it'll become even more so at that point in time. So, that's inflation and deflation. Basically, your ability to buy things is either growing or shrinking based on whether or not, which is growing your buying power, or inflation, which is shrinking it. It's pretty easy to see why these things could be bad, right? Inflation obviously means that saving money makes you an idiot. So it encourages people to spend their money foolishly. Uh, and it discourages people like you and me who want to save their money so they can invest it. It discourages that, even though investment is good during inflationary times, but it's hard to save up to make the investments. Oh, sorry, or to make the purchases because prices keep rising. Deflation, on the other hand, has the opposite effect. Because the value of your money keeps increasing, it encourages you to delay consumption, right? Why spend $10 today on I don't know what costs $10. Why why spend $10 today on a keyboard when next week it'll be $8, right? When a month from now it'll be $6, when a year from now it'll be $4, right? So you can see how that problem works, and obviously depends how strong deflation is. If your money's going up really quickly, it may actually stop people from consuming. If your purchasing power is going up like 1% per year, it probably will have a very limited effect on what people choose to buy or not buy. So that's inflation and deflation. So what is stagflation? Because it really seems like there's not really a place for something. We've got our two polarities, right, up and down, and stagflation doesn't really fit. And in a lot of ways, stagflation doesn't fit with inflation and deflation because stagflation isn't actually inflationary or deflationary. It's kind of something else. And what stagflation is specifically is stagflation is when you have an inflationary environment. So that is your purchasing power is going down, right? while at the same time while at the same time you have a surplus in the labor market. Okay, so you have inflation causing purchasing power to fall, and you have a surplus in the labor markets, meaning that people are losing their jobs or wages are falling, one of the two or both, right? And that results in stagflation, which means that the supply and the demand curve become fixed in a low demand, low supply. And you the idea essentially is that the economy locks up and things stop moving. So there are not people to buy the goods. The people who are working are losing the value of the money that they're earning faster than they can spend it. And the majority of people aren't even working. So they're falling further and further behind. I know that this is a very cheerful picture I'm painting for you at the beginning of January. The reason I want to mention stagflation is because I mean, it looks like it could be a distinct possibility. I'm not saying it's going to happen. Nobody can predict the future, and I wouldn't sit here and try and tell you that I can. But it does look like the ingredients for creating stagflation are here. Usually, it's runaway government spending uh, combined with bad monetary policy. What we're seeing right now is runaway government spending, and the Bank of Canada has been holding interest rates extremely low. So, why does this kind of happen? Okay, well, I call this the interest rate investor trap, and it's a pretty straightforward thing. I'm going to take you through it right now. I'm going to show you on the screen for those of you who can, oh, wrong computer, wrong mouse, whatever. I'm going to show you on the screen for those of you who can see, and I'll do my best to explain along for those of you who are just listening. Let's share my entire screen. That's easiest. Yeah, share. Okay. So on the screen now, for those of you who can't see, I have a property. This is a Toronto property. It's actually a Rexdale property. I was looking at a house in Rexdale. And so this property is for sale. It's $1.5 million. Well, 1,499,900. And actually, before we go any further, I'd just like to remark upon that right there. That's somebody who is trying to appeal to first time home buyers who can CMHC their mortgage because the CMHC limit was bumped up, right? And I think it was bumped from a million to 1.5. That's the limit. So you can see they're priced right at the limit of what CMHC can allow a person to afford because they're probably a very savvy realtor understands that nobody can actually afford this house. And the demographic to buy this house, being like first or second time home buyers, um, are going to require CMHC mortgage insurance because they won't be able to come up with the down payment. So it's just an interesting thing that you see there. But anyways, this property is for sale. It's $1.5 million. Okay, cool. So we're gonna just look through the numbers real quick, and don't expect this to be like a cash flowing property. It's not. At best, it's maybe a decent house hack in Toronto. So again, $1.5 million. So you put down $150,000 at 10% down because you can do that. And we'll just run through real quickly. You'll get maybe $3,500 a month for renting the upstairs unit. In this case, I was looking at it. Maybe I'd live in the basement, so I didn't put in the second rent, but you could. That might be another $2,000 or $2,500 a month. Here we can see principal and interest. So our mortgage payment is $5,081 per month, right? We have all of our other expenses. We won't get too into the details. $6,200 a month basically is our gross expenses. We have withholdings. In this case, it's in Toronto, so I figure you'll manage it yourself. So I didn't put a property manager in there, right? You see there's no property management. So with withholdings, we've got vacancy, of course, Toronto, very low vacancy rate, so 1%. Repairs and maintenance, 7.5%. The house is in decent condition. I always do my tenant thing, and there's a water tank to rent. So another $60 per month in withholding. So in total, we lose about $3,000 per month owning this house. Okay. So that's not that great because negative $36,000 a year is hard to swallow. And so you can see here, year one, our cash flow is negative $36,000, but we pay down $42,000 on the mortgage. So, we're up $6,000 approximately. And then assuming the house appreciates, just what is that, 2%, it'll go up $30,000. So we're up 36 or $40,000 kind of thing, right? So you can see as an investment, not too terrible. And again, if I added another $2,000 a month or so for that second unit, then you'd be down to only negative 1,000 or so cash flow. You can see, so you could see how you'd actually do quite well, right? Because if you make what is that, $72,000 on the passive side, and you lose about 12,000 on cash flow, you're making 60 grand a year, right? It's illiquid, so it's not a, but it wouldn't be too bad, right? So that's what you do. You buy this house this year. That's what your numbers look like. And this is the trap. Now, I called it an investor trap. The funny thing is it's actually going to hit consumers a lot harder than it hits investors. And that's why I wanted to show you this style of house instead of a multifamily to illustrate the point. I will show you a multifamily as well. Um, there are a couple things to note here. Uh, I did not double the land transfer tax, which you would have to do because it's in Toronto. So it would actually cost you $52,000 for the land transfer tax, not 26. But that's not really important to the point I'm about to make. So here I'm clicking over. This is the same exact property. I'll just zoom in again for those of you who are looking. This is the same property, Hathor Crescent here in Toronto. Same cost, same everything. And in fact, the only thing that has changed on my analysis, can you even see? I don't think I give you that information here. It's up here. Pardon me. The only thing that has changed on my analysis now is now the interest rate has jumped up. So the interest rate has gone from 2% to 4%. And the reason why this is important is obviously interest rates are super duper low. They're actually sub 2% if you're willing to take a variable rate mortgage. And so it's very easy to look at a property like this at 2% and think, oh, I can handle a $5,000 a month mortgage payment, no problem. And so you buy the house. And of course, everybody knows interest rates go up, prices increase for sure. But I'm not so sure that they necessarily realize how heavily they can get hit by the increase, right? So here we jump up an extra $1,000 per month, right, is coming out of our pocket when the interest rate goes up this 2%, right? Which means that extra $1,000, it's over 12,000 extra dollars per year that we were paying. So this property was losing us almost $36,000 per year, which is pretty bad. Obviously, we made up the money on the back end with the mortgage pay down and with the passive appreciation, but it was negative $36,000 per year cash flow. Now we've jumped up the interest rate by 2%. It is now negative almost $52,000 per year in cash flow, right? So you can see how the person who budgeted to lose $36,000 is now going to lose $16,000 more because the interest rate jumped up, right? And this is the trap, right? Is people are going to buy into these properties and they're going to look at the price going up, right? And so they're going to say, okay, maybe I can afford to lose that $36,000. I mean, a lot of people won't even say that, but maybe they can afford to lose 10 or 12 or something like that, right? But I'll make it up on the back end with this passive appreciation with the principal recapture, and it'll be fine. Look at the prices in Toronto; they're crazy. They go up. You know what? Here I'm analyzing that passive appreciation is going to be 2%, but let's be real. It's going to be 10, right? At 10% of $1.5 million, $150,000. So this property is going to make a lot of money, right? Except, of course, that's not quite true, is it? So here I'm going to show you one more thing. This is again 33 Hathor, but this time it's at a 6% interest rate. Okay, so everything else has remained the same. We've only played around with the interest rate, and you can see now our monthly payment is up to $76.77. Okay, which means our total mortgage payment now for the year is going to be $92,000, which means that we are going to have to pay negative cash flow almost 67, almost 68,000, 67,500, so almost $68,000. Okay, now the purpose of this is to illustrate, obviously, something we all already knew. Rising interest rates increase the cost of home ownership. That much is clear. And you can certainly protect yourself against running into this situation, falling into this trap by buying a fixed rate mortgage. At least for 5 years, you won't have to worry about the changing interest rates. You do pay a little bit higher, and a lot of the times it's not the best idea because a lot of the times we don't take our mortgages to the 5-year term, but it can work, especially if you're buying property like this one in the GTA here, where it's in a more precarious situation than say an investment out, in Sudbury or Cambridge or something, right? But here, so we can obviously see now this house is losing a lot of money, a lot more than whoever bought it originally intended to when they were looking at it at 2%. Now, is it realistic for interest rates to go from 2 to 6%? Um, that is actually the upper limit of what is reasonable. In Canada, there are restrictions on how much the bank can increase your mortgage interest rate. So even when you have a variable rate mortgage, it actually is not an open variable rate mortgage. They can't just, if the interest rate goes from 2% to 10%, they cannot increase your interest rate from 2 to 10. That's not how mortgages are structured in Canada. There's a maximum increase that they are allowed. And I am not a mortgage broker, so always speak to one first. Don't take my my advice because I might be forgetting something or misremembering. But if I recall correctly, the maximum increase that they can impose on you is about a 4-point increase. So if you were at a 6% interest rate, they could take you to about a 10% interest rate. It's about that. I might be off by a point. It might be a 5% increase, something like that. But there is a cap. Hopefully that helps you sleep at night. I mean, you're still going from 2 to 6. You can see how devastating that is. Something to be mindful of. Now, there's the economic element to this, right? So far, I'm just showing you what's happening to the investor or the homeowner, right? But we need to look at what's going to happen in the economy as this happens, right? So you can see here, obviously, lose money, or if we take the scenario of the like over optimistic investor who's expecting 10% passive appreciation, we're now in a precarious spot. We're not losing money because 150,000 is a lot of passive income, but you'd be down to only about 80,000 after your negative cash flow, right? Okay. So now what's happening in the economy? Okay. Let's say this is the situation. You're the investor. You bought this house at this price, blah, 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 2%, the whole thing, and it's gone up to 6, right? And now you're looking at it's gone up to 6, and you say, I can't afford to put $67,000 per year into this property. I have to sell it. Okay, no problem. Take it to the market. You're gonna sell it. Well, you paid $1.5 million for it, right? So how much are you gonna sell it for? Because at the time that you were selling it, right? Or sorry, at the time that you were buying it, your property at $1.5 million cost $5,000 a month to own. Your property today at the exact same price now costs $7,700 per month to own, right? So 7,700, right, over that $5,100 that it was costing you is, holy crap, is that right? That's almost a 50% increase in mortgage cost, which, yeah, that is right. Yeah. It's almost a 50% increase in mortgage cost. Okay. So, what that means essentially is that even though you bought the house for 1.5 million and now you're trying to sell the house for 1.5 million, so you're trying to break even, the cost of the house to the buyer has actually increased by 50%. So, you're actually trying to sell this house now for $2.25 million in the head of the buyer, right? Because they have to finance. And so now you're trying to make up $750,000 that there's no way anyone can afford to pay you. And since we know that it's $750,000, that's basically the difference. We've kind of figured out what kind of a discount you need to offer people to take that house off your hands. You need to find a buyer who was as willing to own that property as you were at $1.5 million. We know what the discount needs to be. It needs to be almost $750,000. Now, if you sell this house at a discount of $750,000, then it's going to cost $750,000, right? Because that's half of its value. And you're going to lose $750,000. And this is the trap. The trap is that when these interest rates climb, if you own a property like my sixplex in Sudbury, that cash flows, right? If you own a property that cash flex in Sudbury and the interest rates increase, yes, my mortgage payment will go up, of course. but I still cash flow because I'm cash flowing such a gross amount right now that if it goes up, my mortgage payment goes up 500, maybe even $1,000, I will still be able to break even. Right? That'll be the upper limit, but I'd still be able to do that, right? So I just hold the house and sit tight, and I continue to make money. But if you own a house where you don't have the cash flow cushion to absorb those rising interest rates, then you may find yourself in a position where you need to sell because your monthly cash flow becomes negative enough that you can't afford to keep that property, right? Now, selling is not a big deal. I mean, taxes and stuff, it sucks a little bit in terms of it costs you some money. But if you bought the property well a few years ago and you sell it, you're going to make a profit, right? So that's fine and good, right? The trap is not when you buy properties right in markets that are appropriately priced, right? The trap is when you're in markets that are heady or they're at the top, like the Toronto market is, right? The trap is that at that point where you're approaching and at the top plateauing, it looks like, well, prices will only go up. And from a sheer dollars and cents perspective, that's not unreasonable logic. Like I said, in theory, this house now with the higher interest rate is basically a $2.25 million home at the lower interest rate, right? And that's true. That's what interest rates play with, right? Interest rates play with the upfront cost of the property versus the overtime cost of the property. And obviously, the higher the interest rate, the higher the overtime cost. And the lower the interest rate, the higher the upfront cost can be, right? When interest rates do. So when they climb like that, they squeeze people. They squeeze people exactly like this because now this person finds themselves in a situation where they can't afford the property anymore. They have to get rid of it, right? Because they're running a deficit, right? Their personal budget is running a deficit, and they are not a government. They can't run an indefinite deficit. Eventually, their creditors want money, right? So you have to fix deficits in your own life. And so this person's running this deficit. It's a big deficit, $260,000 a year deficit. That'll bankrupt you really, really quickly, right? So they're running this big deficit. I mean, technically, imagine if you lost $60,000 a year. Like, even if you had, let's say you had $1 million saved up, you're only about 12 years away. No, not 12, but you're about 15 years away from insolvency. Like, anyways. So they're running this deficit now. They need to. They had this thing that they thought was an asset. Now, obviously, just from what I've laid out for you, this was never an asset because it doesn't cash flow, but still, they thought it was an asset. They had an asset column. It's now very clearly and heavily a liability. So they want to get it off of their balance sheet. They've got to go sell it. They go to take it to market. Of course, the market value at the time they purchased it was $1.5 million. So they have 20% or 10% of that in equity in the property, right? And then the rest is from the bank, which they owe back to the bank. But now, because interest rates have risen the way that they have, and buyers are looking at financing the property, the only people you can sell to are buyers who are financing the property, who are going to have a long-term time preference, right? So now you go to sell to these buyers, they cannot afford the long-term expense at these higher interest rates unless if they get a discount on the upfront cost. So you have no one to sell to. So now you're caught in a position which is either you sell the property for substantially less than it's worth and you take a huge loss, or you hold the property and allow it to slowly bleed you to death instead of quickly doing so. But either way, you end up bankrupt, right? Now, bankrupt is extreme. Most people who find themselves in this position, they don't end up bankrupt. They just take a big loss. It sucks. For some people who live their financial lives too close to the edge, this will definitely bankrupt them. But for your average person, hopefully they had some savings and what have you, and it just hurts badly, but it just hurts. This is the trap. It happens to investors and the residential buyers, right? As you can see, obviously, if you're a residential buyer and you were just planning to eat $36,000 a year, and then that jumps up to $52,000 a year, or it jumps up to $68,000 a year, you can see how that just, the investors actually, they're much better off because they're at least collecting some rent to defray some of that cost, right? But either way, this happens to both groups when they overextend themselves in this type of market when the interest rate turns. So that's something that's very important to look out for. The interest rates have not turned. The government is frankly being incredibly irresponsible. I don't need with you. For those of you who understand, you understand. If you don't understand what I mean by they're being irresponsible, don't worry about it, but they are. They are not allowing interest rates to move freely. And what that means basically is sooner or later they will move of their own free will. Right. It's like trying to hold back a waterfall, right? If you dam the stream, that's fine, but the stream will build up and eventually it'll go over whatever your dam is, right? Like there's no stopping it. There's only really delaying it. It's the same thing with interest rates. And so sooner or later, they're not going to be able to hold back the interest rate, right? It might be something that happens outside of Canada. It might be something that happens inside of Canada, but one way or another, something will happen and interest rates are going to have to rise, right? And when that happens, these people who I've just kind of highlighted for you, right? They're not your average person necessarily, but whoever they are, these people who make this mistake, who fall into this trap, they're going to get squeezed really, really hard and they're going to cause prices to fall. Right, that's the last step in the real estate business cycle is that the fools get squeezed and then prices fall. And the reason that happens is really, really simple. These people are going to put these houses up for sale at a price that nobody can afford them because that's the price that they need to capture to recoup their losses. They're all going to do it at the same time because they're all going to start to get squeezed at the same time, which means that there's going to be a glut of houses that go up for sale at prices that nobody is willing to pay. And what we know about supply and demand is that when you have a large supply and a low demand, prices fall. And so these people are all going to put their homes up, hoping to recoup their money. And that's the worst part. They get squeezed even harder than even the math I've shown you suggests because they all try to sell at the same time because they're all basically beholden to the same variable, right? And so when they all go to sell at the same time, again, there's a glut on the market. And so they all just push each other's sale price down than it would have gone before. And that's when savvy investors like yourself and myself, who've been sitting on the sideline, kind of waiting, maybe spending our money in other markets, but avoiding this one because we knew this was going to happen. That's when we sit down with our plan. And in our plan, we've written down what price we can pay for with rents, right? So we figured out, okay, if the rent's $2,500, then any property with 2 units in it, I can spend $5,000 a month on mortgage or 4,000 plus expenses, whatever, and you just work it out to what price that works out to for purchasing, right? And you just sit there and say, "Oh, I'll buy your house if you sell it to me for this price. I'll buy your house if you sell it to me for this price." And eventually, the investors just kind of run through this backlog of houses, buying a lot of them up. I mean, some will be retail buyers as well, but a lot of them will be investors. They'll buy those houses up basically for pennies on the dollar. And at that point, hopefully, you're in a point where interest rates will start to swing back down, although they may not. The investors will obviously with like some uh, margin, right? Some margin of error for whatever may happen with the interest rates, um, which may actually result in them asking for a further discount from the price, uh, pushing prices down even further. And so this is the investor trap. And this is something that can happen if you get stagflation, for sure, because the only way out of stagflation is to allow um, as far as we know, okay, I shouldn't say the only way as if like that's some scientific statement. As far as we know in economics and government policy and things like that, the only way out of stagflation is to allow the free market to stabilize prices. So you allow the interest rate to move freely and you allow the price of the dollar to move freely. Um, our government is addicted. Addicted is exactly the word I mean to use, like a drug addict. Our government is addicted to controlling and utilizing the cheap money that they get from managing the interest rates and the money supply. And so that's why we haven't seen those things move freely in a long time. Uh, and like any addiction, uh, you're not going to give up your drug of choice voluntarily. So the reason I mentioned stagflation is because I think we might have to wait until they've created a stagflation situation before we'll really see interest rates move freely again. Now, I could be totally wrong about that. Maybe they'll allow interest rates to move freely, next week, because I can't predict the future. But looking at the way they've been behaving, it looks like that's probably not going to happen. They'll probably wait until they've created a crisis. It's usually how government operates. And then once there's a crisis, they'll have to do something, which in this case would actually be stop doing something. But, anyways, they'll have to do something at that point, and then maybe we'll see interest rates move. And at that point, the trap will be set, right? And whoever's in there will be in there. So it's something I want you to be mindful of, because obviously it's the beginning of a new year, and hopefully you're planning, you're dreaming, you're scheming on how you're gonna make it and what you're gonna do this year. And if one of your goals on your list is to buy a home, and if you live in the GTA, which I know a lot of you do, um, be careful, right? Make sure you understand the numbers. You can buy. I'm not here to tell you you can't buy in the GTA. You just need to understand what these numbers mean, what they're going to do, how they're going to affect you in the future, right? So you can make a smart decision. Ultimately, right, if you want to buy a property and you are worried about this situation, well, you're going to want to do everything that you can to keep that mortgage payment low. You might want to focus on ways you can bring that rental income up, right? And of course, you can always focus on reducing your expenses in other places, so there's more margin, right, for you to absorb increases in mortgage costs, right? Also, you can buy the properties, right. Instead of buying the nicest house on the street, buy the crappiest one and fix it up, so you've built in some equity, right, so that way when prices fall, you had some equity to get cut out rather than it being debt to the bank, right? That's one of the big things. Like if you own this house outright, you had no mortgage, it was worth $1.5 million. Then when interest rates go up, it might go down from being worth 1.5 to being worth $750,000, but it doesn't affect you on the payment side of things because you don't have a payment, right? You own the house outright. So you can see how you will be losing net worth, right? In this situation, you'd be losing net worth. Um, However, even though you'd be losing some of your net worth, it's not affecting your cash flow because there's no expense associated with the interest rate for the person who owns the property outright. Similarly, if you own this property, but you're like 80% of the way through the mortgage, so there's only really $300,000 still owing, well, my math changes, right? The smaller the amount you owe, the less the interest rate affects, right? The bigger your debt, the bigger the effect the interest rate has, right? Obviously, we're talking like gross numbers at the end of the year, not the payment, because it's an interest rate is a proportional thing, right? But obviously, the proportion, a 4% increase in $300,000 is one fifth a 4% increase of $1.5 million, right? So the less money you have outstanding on the property, the less at risk you are of this sort of thing happening. And you can accomplish that again a variety of ways. I highly, 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 highly recommend. Although I think it's kind of tricky to do in Toronto. I mean, I haven't tried, but it just seems like it would be. But I highly recommend trying to do it as a burr, because in a burr, right, in the best case burr scenario, that's basically anytime you've done a fix flip sort of situation, except you didn't flip it, but where you've caused at least 20% active appreciation, right? Because basically you had to appreciate it 20% so you could pull back out your down payment, right? That's what a burr is. In that scenario, if you do a burr, then these properties would be a win for you even when the market turned, as long as you could sell it fast enough, as long as the expense didn't become too great. Also, something to remember is in my illustration, right, we jumped from 2% to 4% to 6%. That's not how the market works, of course, right? So it's going to gradually rise. So you're going to have, as an investor or as a homeowner, you're going to like, if you're doing the technical analysis and watching the trends, you're going to see the writing on the wall, right? As interest rates start to increase, it's gonna become clear to you if that trend's going to continue, and you might be able to sell at say 2.5% rather than waiting for it to climb to 6, right, and leave it for the person who doesn't understand this math to buy it from you at 2.5, not thinking about the consequences of it going to 6. So that's another thing to remember, right? Like I'm telling you this not because I want you to be afraid, right? I'm not a big believer in fear. I'm not a big fan of fear. It's completely worthless emotion. Like I understand being afraid, we all do, but whatever it is you're afraid of, even if you're afraid of a lion, like let's just say you're out in the African savannah somewhere and there's a lion stalking you, it's hunting you. What the hell's being afraid of it gonna do for you? It's either gonna kill you or it's not. Like being afraid does not help. So I'm not a big fan of fear, but I do think we need to understand things. And in this situation, if you understand is that you're playing with, um, there's a lot of quotes out there about how, debt is a weapon of financial mass destruction, and how, you got to be careful playing with debt because you'll get burned and blah, blah, blah. A lot of people like to wax poetically about how dangerous credit and debt are. And, for good reason, they are. I hope it was very clear to you from what I just showed you today that they can definitely be things that hurt you really quite badly, financially, if they're misused or misunderstood. um, but I don't want you to be afraid, because I want you to see this from the perspective, well, now you do understand. Your eyes are open to what the risks and the possibilities are, and therefore you know how to act if you find yourself in the position where it looks like you could be getting caught in the trap, right? And again, it's just be mindful of what the market is doing. Pay attention to your technical analysis with changes in and what is happening in the marketplace, and be prepared to move your asset if necessary, if you do see a real change in the interest rates or in our government's disposition towards them, because that's going to enable you to continue to thrive, right, and stay out of the way of that big obstacle, which is going to be that ever increasing mortgage payment as your interest rates go up. uh, Also, something just to add, this I said that this is going to be a problem. I meant that. But please don't mistake my words. I don't mean that this is something you need to worry about in 5 months. I don't know. For all I know, this could be a problem that's 5 years away. Right? Like I said, I can't predict the future. Nobody can. It's a problem, but I don't know when the dam is going to burst. To carry on the metaphor of trying to hold back the waterfall, right? I can tell you for sure that sooner or later there will be too much water. It'll go around or over that dam, but sure how quickly it's going to do that, right? So it's just something that you need to be mindful of and you need to pay attention to. And then also something, I guess, to add some optimism on the other side, because this is about real estate investing, and real estate investing is about winning in every condition, because investing is about understanding things well enough to win in every condition. Um, there are a lot of great things you can do as a real estate investor in a high interest rate market, right? So let's start with the first. As interest rates go up, the monthly cost, the amortized cost of ownership goes up, which means that the proportion of people who can afford to buy a property goes down, which means that the proportion of people who would like to rent a property goes up. What do we know about supply and demand? When the demand for something goes up and the supply stays the same, the price increases. So, in these inflationary trap situations where dumb investors and dumb consumers are getting squeezed, rent prices are actually increasing. So smart investors are seeing an increase in their rents, which is one of the great things, again, going back to my sixplex, about having a property that cash flows before anything like that happens, is that yes, the rising mortgage rates will squeeze some of my profit, some of my cash flow out of that property. But over time, the increased demand for rental units will bring up my rental income. Right now, because we live in Canada, I have to wait for my building to turn over, and that can potentially take years. But eventually, right, the two things should catch up to each other. In some places in the states, you could just put the increase on your tenants or kick them out of your building, and it's up to you whether you think that's good or bad. But it's weird to say that you own and control something, but you're not allowed to do what you want with it. So that's one thing, is investors can actually come out of this quite good, because rents in the market will usually increase. The other thing is that those high interest rates create opportunities. Um, there's a real estate investment asset. I call it paper investing. I've probably talked about it a little bit here, but I've never really gone into much detail. And that's when you are a private lender. We talk about mortgages and we talk about creative financing sometimes, and we talk about some of these finance products that you can get, that are not from the big five or big six banks, or even from some of the secondary and tertiary lenders. Well, there's also private lenders, and you can be a private lender, right? If you want, you can take your hard-earned money, you can lend it to people to buy real estate. Um, it's actually a much simpler process than you would think. I have done it. It's not that hard. Generally speaking, they want accredited investors, so it's usually not something you can just start out doing. But once you have a couple properties, it is definitely an option to you. And all that is you're lending out the mortgage now, right? So obviously, right now, this is a low interest rate environment. Private lenders are charging 8 to 10%. In a high interest rate environment, they might charge 20, 25, maybe even as high as 30%. I mean, it's going to depend how high the interest rate gets, really. They charge a premium, though, right? When people are having trouble qualifying in those high interest rate environments, they have to go to private lenders. I mean, even in the low interest rate, right? Whenever, if you want to buy something and you can't qualify with the banks and stuff, you have to go to the private lender. So private lenders have a built-in market. It exists. It always exists. There's always people who want to buy but can't qualify. And they lend to those people. And of course, at least the way I did it, I'm sure every private lender is different, but the way I did it, it was basically impossible to lose because there was a lot of equity in those properties, way more than what I was lending them. So if they got into trouble, I would just take their house and sell it and get my money back. Um, so I had, I mean, I worked on about 10 of these or so, like not a huge number, but also not a small number. We had a 100% repayment rate. Nobody defaulted. Nobody did not pay us. There were a couple late payments. Some things happened occasionally, but we received 100% of the money that we invested back and our returns. So it was a pretty safe investment. Obviously, in this kind of environment, it sucks to give up, your nice investment property that's been making you $5,000 a year or $15,000 a year or whatever, right? When the interest rates climb. But alternatively, right, if you can get that equity out of the property, now that interest rates have increased, you can move that money into private lending, right? And you can go get a, 10, 15, 20% return on your money there. And, that's as the interest rates increase and that return becomes more and more attractive, it becomes as good as or better than the return you were going to get on the house anyways, right? So that's something else, right? Is that once you're in a position, one of the things about life just in general is like as you accrue value, not money, value. As you accrue value, you can leverage that value for other things, right? And value is an important thing to understand because if I own a house, it has a value. It also has a price. The price and the value are not necessarily the same thing, right? Sometimes my value never changes. That is, a house is a house is a house. It can hold 4 people in it. Let's just say, but its value changes depending on how many sets of 4 people. Sorry, its price changes depending on how many sets of 4 people there are, right? Supply and demand and that sort of thing. But its value doesn't really change. It's a complicated concept to nail down, but you do need to understand that everything has value, which is, well, we measure value with prices, but value is technically separate from price. A what's a better way to understand what I'm trying to say? If you go to like the duty free shop in like the airport or whatever, and they'll list the prices in like a bunch of different currencies, right? There's a value which more or less all of the currencies agree upon, but they all have different prices, right? So if I can buy a bottle of Hennessy at the duty free and it costs, I don't know, 55 Canadian dollars, 45 US dollars, 85 Australian dollars, whatever. Well, I can be pretty confident that while those prices are all different, if I take that amount of money to each of those respective countries, uh, it's not accounting for taxes. That's approximately what a bottle of Hennessy would cost in each of those countries. And we find that's exactly right because that's the value of a bottle of Hennessy, right? So, same thing with a house or with anything. It has a value, which is the prices can be manipulated in a way that value really cannot be. As you accrue more and more value in your life, just in general, you can accrue it by working, you can accrue it by investing. It doesn't matter how you do it, although investing is a lot faster than working, but do it however you choose. You have the ability to leverage that value, right? And the more of that value that you can leverage, the more of an income you can basically acquire, right? So as an investor, this is one of the things that you really kind of you need to worry about, or you need to look out for a little bit. But understand that as you're working towards your goal of growing your net worth, growing your portfolio, growing your nest egg, if you will, whatever, any of these basically value growing activities, understand and take a lot of comfort in the fact that as that value grows, your ability to leverage it grows. And so your security against shifting markets also grows, right? Assuming that you also gain the requisite knowledge to really take advantage and make the most of your opportunities in the marketplace, right? And that's hopefully why you're here learning today, this morning, and that's something that you'll continue to do. Um, I started reading well, it's a Rich Dad company, so Robert Kiyosaki, but his education company. Anyway, I started reading one of their books on stock investing. It's nothing to do with real estate. I want to one of my other goals for this year is I want to learn how to be a better stock investor. I've invested in stocks, I've made money, I've lost money, I've whatever. I'm not a big stock guy. I don't own stock currently, but I have done in the past. And making money was really cool. Losing money was really crappy. And I feel like it was really good luck when I made the money, and it was real stupidity when when I lost it. And I think there's an opportunity for me to be better. So I'm trying to learn. Anyways, reading this guy's book about stock market cash flow and stuff. And anyways, um he's talking, I guess, basically about growing your investor capital and getting educated. And he's talking about how in the stock market specifically, there are a bunch of techniques that you can do which make it so that you make money whether the stock market is going up, down, or sideways, right? Because most of us think of the stock market, you buy low, you sell high. It's kind of a one direction thing. And he's pointing out that no, you can buy high and sell low, you can buy low and sell high, you can do all sorts of different things. You just need to understand how to do them and when to do them, right? And so that's what he's teaching in the book. Anyways, the real estate market is very, very similar. And so I thought that was an interesting insight, right? Technically, of course, the easiest strategy and the one we're all kind of always hoping for is buy low, sell high. It's pretty straightforward, right? But there are other alternatives, right? And certainly, that's one of the things about investing. I think all investing requires a level of sophistication. Um, and you need to be a sophisticated investor, right? The simplistic real estate investor is the person who's in Toronto who says housing prices are going up. Let me buy a house. I mean, it's a strategy. It works for some of them. Some people make money that way, right? It's not very sophisticated though, right? A more sophisticated understanding is real estate is an asset class that can produce cash flow. And so I invest in properties for monthly cash flow. This is a more sophisticated understanding, right? And certainly the investor who has that more sophisticated understanding with the cash flowing property will over time fare better than the person who's just blindly buying properties in Toronto who's eventually going to get burned, right? And then you could take the level of sophistication beyond that, right? We can start talking about joint ventures, and we can start talking about burrs, and we can start talking about all the different intricacies and different things and strategies that you can do, right? So one of the absolute keys that gives us power as investors is our knowledge, what we know. What we know enables us to leverage what other people know and to take advantage of situations that other people don't understand. Now, when I say that, I do not mean that you must be, Natalie Know It All or anything. Um, you know, one of the great things about life is that you can check the book. Unlike in school where they make you remember crap, that never happens in real life. You can check the book for the answers. You can also call people, right? You may have friends, you may know people like me. You have resources who you can tap on, who can help you to understand, make better decisions, have better understanding, arrive at clarity. And this is all very important, right? You want to build a team of people whose knowledge and judgment you trust, who can help you, and understand that it's not important for you to have all of the knowledge. Really, as an investor, the biggest, most important role that you play in building wealth and investing really is asking the right questions and having the initiative to push the deal forward, right? Those are really the two things. If you can do those two things, ask the right questions and push the deal forward, eventually deals will go through and they will eventually make you money. And as they make you money, there will be more deals to go through. And eventually it's a very virtuous cycle, right? Um, so yeah, I think that's where I want to leave it for today. I didn't really see any properties I wanted to look at, so I don't have any to share with you. Oh, I'm on the wrong screen. There we go. Sorry, Dylan. Yeah, I see your hand there. Go ahead.
Uh, I guess this was pertaining to interest rates. If Bank of Canada, uh, then I think the interest rates kind of like how after post World War II, Canada introduced the baby bonus, and everyone was getting $5, $10 to have a kid, and now kids are Canada's still paying out people to have kids, 120, $200, $250. If they raise the interest rate to 6, 7%, that's going to crumble the economy because people have built their wealth in this poor interest rate time and not expecting a 4, 5 to 6% interest increase. They're going to ruin their economy if they do that. Do you actually see it going that kind of high?
So that is an astute observation, Dylan. You're right. It will ruin the economy if you do that. Actually, I want to be clear because what you're saying is absolutely correct, although it's not quite phrased properly. The economy will be ruined by that change. That change is not what's ruining the economy. The actual thing that's ruining the economy is holding the interest rate down and allowing the economy to adapt to that point and thinking that it would not change. That's what's the actual cause of the damage, not the fact that the interest rate's going up. But yes, you are right. That will do that. As a conscious choice, if you say to me, "Hey, will the government do this?" Well, no. I mean, they don't want to destroy they don't want to destroy the economy any more than we do, right? They depend on it for taxes. Um, Unfortunately, one, they're not very smart and they're not going to make the right decision. But two, even if we say that they're super geniuses and they make all of the best decisions, an interest rate, this is something that you probably were never taught, but an interest rate is a price. That's what it is. An interest rate is a price. An interest rate is a price, just like $1.50 for Coca-Cola is a price. That's what it is. Okay. So when you say that the Bank of Canada is going to hold the interest rate at 2%, what you're saying is that the government is price fixing. They're setting the price for something. Okay. Now I'm going to ask you really quickly, totally rhetorical question, but can you tell me a situation where government price fixing could last indefinitely? Right? Because the thing is, you can definitely fix a price for a time, but you cannot fix a price indefinitely. And so the problem, what I'm trying to illustrate to you, Dylan, and everyone, is not that the government is going to want to increase that interest rate, but that they're going to get to a point where they don't have a choice. They can no longer hold it down. Right. And that's the situation that we're looking at, is that eventually the free market is going to, because really, what is an interest rate? Okay. Just real quick overview, right? Is, let's say I have $100 today and it's you and me, Dylan. We're here and I have $100 today. And you say to me, "Hey, Aaron, I see you have $100 there. I'd really like your $100. Will you give it to me?" No, Dylan, I'm not giving you my $100. I mean, you're a cool guy and everything, but I'm not giving you my $100. Get out of here. So Dylan says, "Okay, I'll tell you what. If you give me the $100, next year, I'll give you $110, 10% interest rate," right? I go, I really like having $100 today, but $110 in a year seems better than having $100 right now. So here you go, Dylan. You can have my $100. That's what an interest rate is. That's, I mean, I'm super simplifying things, but that is it. That's all that it is. It's, you've got money and I'm coming to you and saying, "I want your money." Well, you're not going to give it to me for free. That's for sure. Right. So then the question is, well, how much do I have to pay you to get that money today? Everybody prefers to have money today than tomorrow, because tomorrow I could be hit by a bus, but today I can take that money and I can go spend it on whatever I want. So all of us have a time preference for today. So how do I convince you to overcome your preference for today to wait until tomorrow? The answer is, I pay you interest. This is a free market activity. The government has stepped in and said, you cannot ask for more than $2 per $100 next year. Well, okay, but it might be the case that I have such a strong preference for my money today that unless you offer me $150 next year, I won't give it to you, right? And that is exactly what happens. So, as the government holds the price down, as they hold the interest rate down, the supply of people who are willing to give you money for the future is reduced. So, now how do we get the money? Well, what the government's been doing is they print that money. So they just go, oh, forget it. Who cares that the supply is falling? We'll print the money to make up the difference in the supply, right? So they're printing the money, and that's the money that's getting lent out. Well, this has a whole bunch of costs. First of all, people who are savers are losing out because the government is stealing from them because those people could be charging 6% for their savings and making 6% interest per year, right? But now they can't because the government's outcompeting them at 2% with money that they're printing. But of course, the money that they're printing, right, is now causing inflation, which means that those people who have savings are now losing money. Okay. And that inflation, because it's causing them to lose money, it's now putting pressure on them. They're now incentivized to spend the money even faster. That means their time preference is becoming even shorter because I don't want to hold this money even for 6 months because it's losing value. Right. So I want to spend it right now. Which means now, if you come to me and you say, "Hey, Aaron, you have $100. I want to borrow it. I'll give you $110. Are we cool?" I say, "No, I need $125 because the money's losing value so quickly." And so you get into a point, basically a place of no return, where eventually nobody's willing to lend, and your only way to print more money until people don't want your printed money, and then you're screwed. And the reason why you're screwed is because you're not only dealing with Canadians. You see, if you were only dealing with Canadians, it'd be okay. You'd just pass a law and you'd say, "Hey, Canadians, screw you. I don't care if you think my money's not worth anything. You have to take it." Right? The problem is that eventually I'm borrowing money from the Japanese or the Saudis or the Americans or somebody, and they don't want my Mickey Mouse dollars. They refuse to accept them. So they're eventually going to say, "You're going to pay me in oil. You're going to pay me in gold. You're going to pay me in diamonds. You're going to pay me in pork bellies." Whatever it is, but you're not paying me in that worthless Canadian dollar. You're not paying me with Zimbabwe dollars, right? That's what ends up happening. And at that point, doesn't matter how delusional your government is, interest rates are going up. And so that's kind of the fight that the government has is they can, as you point out, Dylan, they can kick and scream and fight and say, "No, this is bad for the economy. I don't want to let this happen." And they can do that for a time, but eventually it results in insolvency. Actually resisting the interest rate increase is the worst thing you do for the economy because it just makes the adjustment period that much more difficult ultimately, right? And so that's the thing is that really and this is one of the funny things, right, is if you listen to the media, if you watch the news, or if you watch some of these like MSN Money or some of these things, if you listen to any of these kind of media things, they talk about these things as if this is just like something the government decides, and it's not. There are free market principles at work behind these things that make the decision. And the government can, of course, step in and mess with the economy. They can always do this. This is government's what they do, right? But they can only do that for so long, as we see time and time and time again. The government can come and they can distort the market, but they can't distort it forever. They can only distort it for a time. And especially with interest rates, it's one thing if you say, "Hey, we're going to fix the price of beer at a buck a beer," right? You might be able to get away with that for a long time because beer, for better or worse, love it or hate it, beer doesn't actually go into that many things. It's just a consumer good. It's this one little corner of the economy. It's whatever. Interest rates go into everything. So an attempt to control interest rates is an attempt to control the entire economy, right? There's no product in the economy that is not affected by interest rates, right? And so it's an incredibly difficult thing to control long term because it affects everything, right? And that's the trouble that the government has and is having. And you're seeing it right now, right? We're holding like 4% interest rate, I think was the last quarterly report, something like that, which you all know is nonsense. I drive a Volkswagen Golf. It's a small little car, and it costs about $55 to go from an empty tank, and like I literally drive until the car says there's 0 kilometers of range left. Empty tank to a completely full tank, $55, or at least it did a year and a half ago. The other night I put $60 into a tank that was still about 1/8 full, and I did not fully top it up. So obviously, inflation is higher than 4%, unless we're going through some sort of fuel crisis I haven't heard about, right? The inflation is actually higher than what they're reporting it to be, right? And sooner or later, that is going to hurt people enough that it will become economically unviable to do nothing about it. At that point, people will demand that they do something. And really, this is the problem. This is why I'm such a downer on the government in general, is because they create a problem that creates a problem that creates a problem that creates a problem. And every time they try to fix the problem, they create a new problem. And if they just left things alone, it's not that things would be problem free, but there would be fewer problems and they'd be easier and fairer for people to predict. Right? Like, this is the thing, is like, you do not get away from interest rates fluctuating by not having the government. But what you do is you make it a free market where smart people get ahead and dumb people don't. Whereas when the government gets involved, you make it a distorted market where cronies of the government get ahead because they know what the government's going to do and everybody else gets screwed. And that's like the worst possible in my eyes. This is the worst possible outcome, because I at least want to live in a world. If we got to live in an unfair world, I want to live in a world where the smart people get ahead, not the people who are, government cronies. That's always a recipe for bad, right? And yeah, so they're definitely going to have to raise interest rates at some point, Dylan. But you make an excellent point, which is, while it will happen eventually, they will fight tooth and nail to try and avoid it. Because usually, like, just to speak about the politics for a little bit, just briefly, usually when the government, doesn't matter, conservative, left, right, up, down, middle, purple, doesn't matter, any of that stuff. When the government is in power, right, if interest rates increase sharply, they usually will fall out of power. Generally speaking, when you need too badly, doesn't matter left, right, center, up, down. No, that stuff is all surface level crap, right? People care about eating. So when you mess with the economy and people are worried about eating, you're out. It doesn't matter really what your politics are. And that's true for inflation too, right? Same thing. Again, people are worried about eating, and if they see their purchasing power decrease by 30% in a year, or year on year, yeah, usually that government is not going to be long for the world. So the government, regardless of who the ruling party is and their political ideology, they will usually try to avoid these situations as best they can, because they know they probably will not get reelected, right? And so that puts very strong incentives on the government to try to avoid these problems, which of course just makes the problem bigger whenever it does actually, whenever we do actually have to deal with the interest rates.
That that was my point, because it should, if they want to stay in power anything long, they want to have to just replay this game. But that time could be our lifetime, just like how the boomers ruined our whatever you want to say environmental causes. Just keep drilling, keep fracking, keep coal burning. That could be the next guy's issue.
Yeah, yeah, you're absolutely right. I mean, from what I've seen of economic history, it looks like usually these kinds of things, they can linger for quite some time. Like, it could be the next 30 years, but they don't linger for so long that it would probably like cover our whole lives. Fortunately, I mean, hey, look, the next 30 years are probably the best years of my life, so I don't want it to go down that way. But I'm just saying, that's how it happens. Obviously, if the economy does go that way, Canada's not the only economy on this rock. You can live somewhere else where maybe we haven't been so stupid with the economy. Alternatively, sometimes it's your number, Dylan. You talk about the baby boomers being a very irresponsible generation, and they were. But the greatest generation before the greatest generation before them, those are air quotes for those of you who can't see. Uh, they got stuck fighting World War II, right? And like, wasn't really their fault, right? World War II was basically caused by World War One. And they had nothing to do with that, right? So, I mean, this is life. Sometimes it's one of the funny things is in this. I'm just gonna kind of go here. This has nothing to do with real estate at the moment. If you want to leave, feel free. That's just my opinion about something kind of unrelated. But it's funny that in modernity, in kind of the modern era, we've kind of atomized society. We kind of see everything as very individualistic, which is fantastic in a way, because I should make my own decisions for my life and you for yours, and so we are individuals in a way. But we've really come to this point of atomization where it's almost as if people believe that they can just be and do whatever they want, regardless of the people in the society around them, because those things aren't important. And everybody's opinion on that is going to be a little bit different, but it's hard to escape the reality that like uh the actions of the people around us and the people before us, they impact us. I mean, there's no getting around that, right? And it's such a peculiar picture that like in the modern world where kind of in so many ways we've gotten much more accurate understandings of a lot of things, it seems like the picture's gotten a lot clearer when it comes to like what a society is and what responsibilities we have to each other, and you know I mean, and I don't even know the answer to that because I'm sitting here thinking for myself personally, my own ethos, like I don't think I have a lot of responsibility to other people. I mean, I genuinely I don't think I owe other people anything. I'm happy to freely give back some time and some knowledge like I'm doing right now and try to help people. And I think it's right to be a good, just a good person and try to help people. But I also don't think I owe you help, right? Like if you're hanging off of a cliff, it's not my responsibility to save you. How the hell did you get there in the first place? Right. And like, yeah, if I can help you, it makes the world a better place. But also maybe you shouldn't fall off cliffs. Like, you know, and I think that analogy applies to a lot of things. And just we kind of have a society that's, I don't know. It kind of seems it's kind of like we've kind of decided that it's every person for themselves in a very weird way where we've kind of decided that while at the same time like our society's kind of flirting with this sort of like communistic kind of like socialist kind of very collectivist notions. I don't understand it except to say this. Think that if everybody who's listening to me right now was to give me their money so that I could invest it for them on the assumption that I'm a halfway decent investor, I would probably lose a lot of your money. I think that's what would happen. But if I invest my own money, I multiply it. And if you invest your own money, you'll probably multiply it too. And if we do that, we may actually end up substantially wealthier than if for some reason we all get together and vote and say, well, I'm the smartest or the most experienced or the whatever. Let's give me the money. Because, like, I'm going to get lazy. It's not my money. I didn't work for it. And I really think that's a very dangerous thing, right? When as a society we collectively say, well, let's let him control the money because he's smart or whatever. And it's like that it's it's never worked in human history. You give people the opportunity to steal from each other, they will. I mean, not to be too dark, but if we look at like the history of slavery, and I don't mean the history of Black American slavery in America, I mean the history of slavery, right? People have enslaved people in all sorts of cultures and societies all over the world, all throughout history. And that's really hard work. Like, it's really hard work to enslave a person, and yet people still went to the effort to do it so they could get free stuff, right? So if you say that people are willing to do that much work for free stuff, and then you say, "Oh, well, you know what? We'll let you print money, and that'll let you get free stuff. Be responsible." Well, is there even a 1% chance that the person you give that power to is not going to abuse it? Like, is there? Of course not. And yet here we are as a society, and I mean, we've been behaving for over a century now as if that person is trustworthy, when all the evidence is to the contrary. Uh, I'm gonna let you go, but one last thing before I do. Maybe, hopefully, some of you have heard of something called the Bretton Woods Agreement. The Bretton Woods Agreement was a treaty. It was an agreement made primarily between the Western European nations after World War II, although there were other signatories as well from Asia and Africa and stuff. The Bretton Woods Agreement was a treaty that agreed that the world would use the U.S. dollar as the reserve currency of the world. Okay. Now, how did this treaty work? It was pretty simple. World War II was over. America was one of the only countries that hadn't been destroyed, modern developed countries that had not been destroyed. And so basically, it was kind of a winner take all situation where they just said, "Hey, look, you're gonna have to trust our economy because you don't have one." Ha ha ha! And the whole world went, "Yeah, okay, fine. I guess you're right." And the world really, they didn't acquiesce that easily, as easily as I'm making it sound. But at the time, the American economy was backed by the gold standard. And so they didn't really feel that uneasy because gold meant that really the economy wasn't under the control of the Americans, it was under the control of the gold supply. So that was the Bretton Woods Agreement. I think it was signed in, maybe it was 50, might have been just before in 1950, but around that time anyway. So the whole world more or less signs on to this agreement. We're going to use the US dollars. That's why everything's priced in US dollars. In case you've ever wondered why, because that's really weird. That's the reason why. It's the Bretton Woods Agreement. Anyways, this Bretton Woods Agreement gave the United States an immense amount of power. Um, there has always been more or less what's called a reserve currency of the world, more or less, maybe informally at times, but there always has been. And with it comes a great deal of power. England has had this power at one point in history. France had this power at one point in history. The Germans tried to get this power. That's actually a big part of what World War One and Two were about. It's been fought over a lot. Great power. Anyways, the Americans end up with it, and everybody agrees. Okay, you're gonna have this power, and um, they give it to the Americans with the understanding that America must stay on the gold standard, and that's going to kind of stop them from being irresponsible for the power. 20 years later, in walks Richard Nixon. Now, the media has done a fantastic job of miseducating you about Richard Nixon. They believe that you should care about him because he thinks that Jews suck or something like that. That's what the Watergate scandal was about. Of course, Richard Nixon's anti Semitism is really not the thing about him that was bad. Richard Nixon's dishonesty is the thing about him that was bad. And the thing that Richard Nixon did, really, other than being mean to a couple of Jews, and actually, it's not clear that he ever was, he was just on record talking to non Jews about how he didn't like those Jews. But, anyways, the thing that he actually did that was actually bad, rather than the BS that the media has pushed about him, was he ended the gold standard in the United States of America. And when he ended the gold standard of the United States of America, A, he was in violation of the Bretton Woods Agreement, which said that they would remain on the gold standard. But B, he changed fundamentally the paradigm of how the entire world worked. At that moment, when he did that, he essentially legalized the theft of wealth from all other nations on the earth by the United States of America. And they were able to do this through the process of printing money, just like the government of Canada can steal from you by printing money, because the American dollar is the reserve currency of the world and not just the United States. When they print money, they increase the world's money supply, and so they can steal through inflation from everybody. And that's the reason why the whole world's economy seems very US centric today, is because uh, through that agreement and through the decoupling of the US dollar from the gold standard, it basically has allowed America to just print a bunch of money. And what happens when you have money printing, right, is here I'm trying to teach you the basics of business and investing so you can go out and you can invest or run a business. You can do either of those things with the knowledge that I try to share with you here, and you can improve your life and you make the world a better place by improving your life. But why bother doing that if you could just be friends with the guy who controls the money supply, right? And so what you need to understand is that at any time, it doesn't matter, all throughout history, back to the Roman Empire and before, when you had somebody who was in control of printing the money, you'd have people who try to be their friend. Obviously, this is the clearest thing ever. And what eventually happens is that your economy is, when it's merit based, right? Then, for example, you get somebody like Elon Musk who's changing the world by building rocket ships that land themselves and cars that drive themselves and just in general, just doing incredible stuff, right? You get him, and he works hard and he gets rewarded handsomely for what he's doing. And those are the types of people that you want. People who, yeah, don't get me wrong, his life is excessive and he's incredibly rich and all that, but he's genuinely making the world a better place. But when you have money printing, you also get people like Elizabeth Warren, and I'm going to pick Elizabeth Warren specifically. I hope none of you like her as a person or a politician. If you do, you may not like my opinion going forward. But Elizabeth Warren recently called out Elon Musk, and she called him, I can't remember if she called him a deadbeat or a slacker, something like that. Anyways, and Elon Musk this year set the Guinness Book of Records for the largest ever U.S. tax bill. So he pays more taxes than any American human being in history has ever paid. Elon Musk in 2021 paid. And Elizabeth Warren, who is a sitting American, I think she's a congresswoman or a senator, one of the two, said that he was a slacker or a freeloader or whatever, even though he pays more taxes than any other American in America. She, as a senator or a congresswoman, pays no taxes at all. She has a net worth of like $100 million or so, which doesn't make much sense because she was only ever a university professor. So her money, almost guaranteed, is a result of stealing from the government, right? And I don't mean like she's stealing from budget. I mean her proximity to the government allows her to extract rewards from the apparatus. And this is the thing that everybody points to and calls corruption, and they don't like. People, left, right, or center, do not like corruption. She happens to be a left-leaning politician. Do not get me wrong; there are plenty of right-leaning politicians who are there stealing money as well, right? Because you have the opportunity. You're putting these people next to the money printer. What do you expect them to do? Right. And the way to have a society where that does not happen is, again, going back to what I was saying, is if smart individuals are making their own money being smart, and there isn't a way to cheat the system so that the people who end up wealthy are just doing good things for society, like Elon Musk, right? Like I don't know. I was trying to think of a good real estate, like a Grant Cardone. I don't want to say any controversial real estate investors. So like a Grant Cardone or something like that, right? Those people are making the world better for everybody. And that's the kind of behavior we want rewarded. Whereas like Elizabeth Warren, she complains. That's she's a professional complainer. I mean, that's basically what a politician is, right? And I don't really like professional complainers because I don't really like complainers. Stop complaining and fix stuff, right? And it's easier said than done, but that's the only way things get fixed, right? So yeah. Anyways, um, thank you so much for taking the time out of your day to join me. Today, obviously, is the first seminar of 2022. Um, I really, I honestly, I can't believe that it's 2022 and I'm doing this seminar. Um, Time really flies because that means it's been about 2 years now. Um, and that's just really quite shocking. Anyways, this year I'm hoping to kind of expand the offering a little bit and hopefully provide a little bit more value to you, maybe in the form of little informational tidbits by email or some other things to help kind of guide you in growing and challenge you to go out and make purchases and do the things that you need to do to grow as investors. So hopefully that'll be coming up in the next coming weeks and months. And hopefully, like I said, it'll be an exciting year for each of you, and you'll all have an opportunity to hopefully grow and invest. And you know, I mean, if you just check in with me once a year and you buy a property every year, in 5 years you'll own 5 properties, and believe it or not, you'll be pretty close to to retiring if that's where you want to be going. So hopefully that's something that more of us can put into practice, and I look forward to seeing you, if not next week, then a week soon. Okay. So have a great day, guys and girls, and thank you so much for your time. Can you hear me, Armando? If you're busy, don't worry about it. But if you're not, I'll talk to you for a minute. All right. I'll talk to you later then.